You could have the best trading strategy in the world, but if your risk to reward ratio is wrong, you will still blow your account. This one concept separates pro traders from gamblers. And today, you will master risk to reward ratio in less than 10 minutes. What is a risk to reward ratio in trading in the market? RRR. I want you to understand this. The risk to reward ratio compares how much you are willing to risk versus how much you are aiming to gain. If we make an example, you risk $10 to make $30. Your RRR is 1:3. Simple. Formula: risk reward equals potential reward. Risk reward equals potential reward. Divide by potential loss. Simple. Example. Let's say right now our stop loss is 20 pips. For those who are new into our tutorial, 20 pips are talking about 200 points. And if you like to actually advance your skill to understand what are we talking about, Bozza, you have mentioning that 200 points. Please understand this. It's important. It's important for you to understand this. Right. Now, let's say we are risking 20 pips and our take profit, our TP is 60 pips, right? And 60 pips, if we divide the 60 with the 20, we get 1:3 RRR. This is our risk to reward ratio. Why most traders get it wrong? Most traders or beginners aim for quick profit. With small take profit, I want you to understand something. My phone is actually about to switch off here. Most beginners aim for a quick profit with small take profits. Right now, if they are trading, just like I did when I was starting to trade, you will end up risking $50 to make $20. You'll end up risking $50 just to make $20. And the lot size that you've opened many lot size, standard lot with $50. So this is what I actually went through when I was a beginner and losing. And that's a losing game if you actually do like this. You are risking $50 to make $20. That's a losing game. Pro traders think risk in terms of how much money they are risking and compared to how much money they are willing to actually win. So to understand the context, you have to use higher time frame to when you trade, when you apply a strategy based on maybe let's say price action, based on chart patterns, based on the indicators or zones, you must understand the context using higher time frame. So pro traders, just like now, I'm experienced. I do understand how trading works. Even with a 40%, all right, win rate, because we have win rate, we have accuracy rate. Win rate doesn't actually show you, because right now we can see here we have 40% win rate. The win rate doesn't actually assist you as to being a profitable trader. It shows you only how often you win and how often you lose. That's it. So it does not assist you to actually make money. But this is important. Risk to reward ratio, it's important. So even with the 40% win rate, you can still be profitable. Even if it's 30%, you can still be profitable. But then we have to break it down for everyone to understand in a much better way. If right now you win 4 trades and you lose 6 trades, please pay attention. It's important. You win 4 times, you lose 4 times. Each win, it's important how much you profit. Each win equals to $300, just an example. And each loss equals to $100. All right? Now, these are 10 trades that we're talking about. 10 trades. Now, profit, we have 2 times now. We have, say, 4 times the 300. 4 times 300. Please use a get your calculator there. Then we say minus, because we have to minus the profit from how much money we've lost. And say we 6 times 100. Then we're left with what? 600 net profit. Simple. I trust you understand. So this is how you can actually see how much money you'll be actually able to make and how to protect yourself from actually losing. Because if you don't pay attention to the risk to reward ratio, you won't be able to understand placing a stop loss compared to how much money you will be profiting. So if you are looking to actually make more money and risk less, use higher time frame. Recommended time frame H1 to MN to find direction and also mark your key zones, your market structure, your chart pattern, your indicators. Use them in higher time frame, then use smaller time frame to confirm whether we are buying or we are selling. I trust you understand. So how often you win doesn't affect your profitability, your consistent. It doesn't. The accuracy rate also. Someone will be asking me, Bozza, what's your accuracy rate on your signals? Listen, accuracy rate actually shows the consistent, but it does not actually shows how much money we are making in terms of and with profit by month end. So this one only focus on the strategy, how accurate is the strategy, and if right now we are trading, what's the plan? So it's mostly focused on that. So make sure that you always risk higher, you always risk lower to profit more. So in this case, you can risk 1, 2, maybe let's say 3 or 4 or even 10. Whatever that you risk, let's say you're risking $1 to profit 10 times that. I trust you understand. So it's important to also make sure that you set a stop loss. If you don't know how to set a stop loss, do not move your stop loss. If right now you're in a loss, you remove it. Please don't do that, right? So that you can be able to build your risk to reward ratio system and know how much money you are risking per trade, the win and losses results. You can have them, right? Focus on understanding the context. Logic, you know, you set a stop loss where? You set a stop loss here. Let's say you set a stop loss below. So it's important to understand risk to reward ratio. I trust you understand. The pips, if you risk in this way, and something that I want to share with you, my experience, is that when you trade in financial market, risk is a two-way street. It's not a one-way street. There is your side of the street, how much money you're risking, and there is the market other side of the street. How the market, we're talking about the graph, the chart, and the graph here has unlimited ways of making you to lose money. So be careful, respect the market. Don't try to outshine the market. Never do that mistake, right? So your other side of the street, make sure that you respect your risk to reward ratio. You know how much money you're risking per trade. You stick to minimizing the risk here using the lot size that is correct. And as you can see, this is how much money we are making in this account. So imagine if we had one standard lot and this was going to be around $3,000, but account, it's important. Remember, on margin, we don't have to lose that money on margin. So we need to be able to calculate that. All right, if we have the $3, the free margin here, some of the traders, they have the skill of using the free margin, but it's much riskier or it's more riskier to use the free margin, because right now, when you use the free margin, you are risking the margin. And when you risk the margin, you are risking to be stopped out. You are risking to lose that money in this trade. You are risking to blow the account, just to keep it simple. So make sure that when you risk, you look at the balance and you look if, okay, right now I want to risk, let's say, $3 out of this amount of money. And you can take this amount of money, divide by 3, and you'll see how many chances you have. If you take 191, let's do the calculations together, just to keep it simple and basic. 191 divided by 3 means that you have 63 chances to risk $3 per what? Per 0.01 lot size. And when you risk $3 per 0.01 lot size, what's the expected profit? You have to use the hard time frame to find that, because the market will tell you how much money you can expect to profit. In this case, let's use the hard time frame. You can see from here to here, we have to close profit here. We almost time. It's almost time close profit. You can see from here to here, this is our zone, our supply zone. You can actually use the zones. You can use trend lines. You can use indicators, but you must understand the entry and exit. This is a swing trade. So I trust you understand. Stay blessed. I love you all. This is how I risk. If right now we have to make 30 out of the 63 trades, we're not going to always make the 30, but on average, let's say we are making the 30, and you say the 30 times by the 63. You say 63 times by 30, then you'll have what? 1,000. It's $1,890. This is how much money you will make when it comes to trading. This is how much money you'll make. You'll make 1,890, risking only $3 per trade, getting 63 trades. But if you lose, let's say you lose what? How many? Let's say you lose 30 trades. If you lose 30 trades, then you will say that what? The 3 times what? 30. Then you have what? You have your 90 here. You are risking $3 and you lose 30 trades, then you have what? You have your $90 here. I trust you can see. So you lose this much. So if you say the 63, I want you to understand something. The 63 trades, and each trade you're expecting to profit 30. This is how much money you make. Then you say 3 trades, and $3 times 30 trades that you lost is 90. Simple. So I trust you understand how we do these calculations. So if right now you lose, let's say you lose 40 trades and times by the 3, then you can see how much money you've lost. 120. Still, you are safe on trading here. You have managed to survive. So you can see how powerful it is to actually manage your risk to reward ratio. I trust you understand. So make sure that you don't trade without risk to reward ratio. Because if you do that, you'll be just like someone who's